Whenever you get into any form of money situation or investment opportunity, I want you to always consider and remember the word risk. Every individual has a different tolerance, a different threshold towards the risk that they are willing to take. And risk management is what is going to save you if you ever get into a tight situation. But before you get into that situation, I want to implore you and encourage you to assess risk before you engage in situations which can have your hands tied behind your back. So, now when we are talking about risk, risk is any situation that may be create a downfall in your investment direction, or things that can potentially destabilize your financial projection. And this can be mitigated by different strategies. The four main strategies of actually managing risk that everyone can consider to use are diversifying your investment, purchasing insurance, which is suggested based on the literature. However, I have some safeguards against that. Implementing risk management policies and procedures, which mean that you have structures in place that if this, then that, so that everything operates automatically. So you could be sleeping and risk management is taking over. And perform regular risk assessment. Every individual needs to know their risk tolerance. Risk tolerance is an individual's willingness to take on risk. It means that it is basically a measure of how much uncertainty or potential loss an individual is willing to accept in exchange for the potential higher rate of return on the particular investment. Risk tolerance is basically a personal scale. So some persons may have a higher threshold and some may have a lower threshold. And this can vary from person to person. You have different appetite. Some persons like vegetarians, some persons like carnivorous. So it is personalized to each individual. But when you understand these concepts, you can personalize these for yourself. So some people may be willing to take on higher levels of risk to the total order or with the mindset of earning a higher return on their investment, while others may prefer a lower level of risk, but you know that may give you a more predictable return, but not as high a return as you may have desired. But if you actually truly desired a higher return, you'll be willing to take more risk and risk the potential of losing more of your capital or more of your invested assets or funds, whatever it may be. So, the next concept I want you to be aware of is risk threshold. So, risk threshold is the level of risk that an individual is willing to take on comfortably. It is a measure of how much uncertainty or potential loss an individual is willing to accept before they begin to feel uncomfortable or uncertain about their investment. So some persons will see their account going down to even 90% and they're okay with that. Others, if they go to 10%, they are panicking. So you have to know where you are on the spectrum, and each person's may have a different positioning, so they will operate on their investment journey differently. Some people may have a higher risk threshold and willing to take on a lot of risk in order to get the potential of a higher rate of return, while others, as we always have the opposite spectrum, will have a lower threshold and prefer a more predictable low risk investment strategy. In general, it is important for individuals to understand their own risk tolerance and risk threshold in order to make informed investment decision that aligns with their personal financial goals and risk preference. So two persons may have the same investment, but one is getting more than the other party because the entry is very important, not only the exit. So you make money in actually the procurement, the purchasing, and that there is where most of the money is made. Because if you buy at a bad spot, then it will take you a longer time to recover. And we want to stay clear from those kind of situations. So risk tolerance is something that has to be considered when you are going to do any form of investment. But I want you to understand the different classes, the four main classes of risk tolerance. First, you have the aggressive individuals, which are persons like myself. This type of risk is characterized by high willingness to take on risk in the pursuit of a higher return. Aggressive investors may be more comfortable with high risk, high reward investments such as stocks, commodities, real estate, futures, forex, whatever it is. They are more aggressive. They don't care if their account is burned up. So those are persons like myself. Then you have persons who are not as willing because of how they had to work very hard for their money. So they want to secure it. But when you're in that mindset, then you are actually limiting yourself. So you have those who come under the moderate risk level, and this type of risk tolerance is characterized by a willingness to take on a moderate amount of risk in pursuit of a moderate return, which is, let's say, basically a little bit above the stock market returns. Moderate investor may get involved in ETF, mutual fund, so these kind of fund, they will get into those. So it is good. It is better to be in a moderate than in the other categories. So then we have the conservative. The conservative individuals, this type of risk tolerance is characterized by a low willingness to take on risk in pursuit of return, which means that they are willing to take some chances, take some risk, but their return based on how they are going is going to give them a low level. So people who have a conservative mindset will get their money in CDs and other money market funds that are low risk, low return. So you may get 1 to 2%, maybe 10, well, not even 10, maybe 7% in some instances. It all depends on the market, the economic, and the fluctuation. Then you have persons who are risk averse. This type of risk tolerance is characterized by individuals averse to risk. So risk averse investors may prefer to keep their money in low risk, low return, such as short term cash, short-term bonds, and you know that these don't really pay you much money, and you are better being risk averse or even in a savings account. That is also for persons who are risk averse, because in a saving account you're basically losing money without even realizing it. So you have to decide where you fall on the spectrum, and then based on where you are, you decide how you're going to be moving into getting the maximum benefit from your investment based on what you desire. Because I know that some persons don't really want to have a lot of money. Some persons just want to have enough money, which baffles my mind when I hear people say they just want to have enough money. If you are a believer in the Word of God, you should have the desire to be the head. And the only way you can be the head is if you have control over the tool set to get you what you need so that you can reach out and help people in the different communities. It is very important to note that risk tolerance can vary from person to person and can also change over time. It is important for individuals to do a regular risk assessment so that they can know their risk tolerance and make sure that their investment portfolio aligns with risk tolerance and their financial goal. And you maybe hear me saying portfolio, and we're talking about the different markets. It is because we are going to be moving away from the idea of even putting our money in the banks. Because if you understand how the banks work and how the banks make their money, and you are in a position where you can do it for yourself, then you are far more ahead than the average individual. So, lack of knowledge is a reason why many persons are in a state in which they are in desire mode, they are in want, they are in a state of lack. Diversification is the practice of spreading your investment across a variety of asset classes, industries, geography, in order to reduce the overall risk of your portfolio. And we have found that if you are not doing your research, a diversified portfolio may be better for you. But if you are a student and you are focused on one area, then a focused portfolio will be more fruitful than a diversified portfolio. A diversified portfolio is for risk management, yes, but a diversified portfolio also limits your potential to earn above the market average. So diversifying is a risk management strategy which involves the spreading out of your investment among the different asset classes. So you may have stocks, you may have bonds, you may have futures, you may have forex, you may have real estate, you may have cash, and industries. When we talk about industry, we're talking about mining, we're talking about energy sector, we're talking about transportation, we're talking about healthcare. Then geography, we may talk about the United States, development in countries, we may talk about Africa, England, whatever area of the world. The idea behind diversification is to reduce risk of any one investment. So if one is performing poorly, you may have the others that will bring that one up. So your portfolio does not take a nosedive. So this can help to reduce the overall volatility of your portfolio and potentially increase the chance of achieving your financial goal. There are several ways to diversify your portfolio, and the most common ones are stocks, bonds, cash. There are others which we will get into as time progresses.